Hello, everyone. Welcome to today's webinar with me, Fawad Razaqzada, market analyst with Think Markets. My colleague Victor, who you may have heard, is also in the room. And today we will be.
Hello.
Hi, Victor. How are you doing, mate?
Well, looking forward to some very important data this week.
Inflation, namely, right? And we have
Yeah.
a few other things as well. But yeah, today's the US CPI coming up at 1:30 London time. It's going to be very important for the markets, especially if we see any significant deviations from the expected figure. But in any case, the figure is most likely to come in above 5% for the fourth straight month, which is very interesting. We'll get to that in a minute or so.
It's just transitory.
I can sense a bit of sarcasm in that. Well, the Fed still thinks it's transitory, but a growing number of economists think otherwise, and I think Victor is in that camp as well. Yeah, so welcome to those of you who are in this room. Please ask us questions during or after the webinar. There will be a session for Q&A at the end, but during the webinar, you can ask us your questions as and when we share some live charts. For those of you who are watching this on YouTube, please consider joining us live next time so that you can ask us questions during the webinar, and we'll be more than happy to answer any questions about any tradable markets with Think Markets, whether that is on FX, cryptos, indices, and so on. Before we begin the webinar, please have a quick read through this disclaimer. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that the spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So, where do we begin then? I suppose we can jump straight to the S&P 500 chart and talk about this trend line that has been in place for the best part of what, 5 or 6 months. 5 or 6 months now. Every time it has come down to this trend line, the debt buyers have stepped in to push the market higher because of various reasons, but mainly because of central bank stimulus from the Fed, ECB, etc. But that stimulus is likely to be reduced insofar as the Fed is concerned in the coming months. And analysts expect the Fed to announce its plans to taper QE either at the November or the December FOMC meeting. And ahead of that, we've seen the markets come down a little bit in recent times. It's been a bit of a struggle for the markets. It hasn't been a straight line, the rally. So let's see if the strength in inflation is going to cause the markets to break down because of fears that the Fed may have to apply the brakes more harshly than it was previously expecting. Is that something that's going to, in your view, going to weigh on sentiment going forward from here, Victor?
Well, yes, for sure. Speaking of straight lines, like the market never goes up in a
Sure.
straight line, but it goes down.
Yeah.
in this manner, and every dip that is getting bought is increasing the risk of straight move downward at some point in time. Will the CPI, the inflation figures, be the trigger that breaks the camel's back? We're about to see that. My my sense yesterday, I was looking at inflation expectations in the US,
Oh
and
yeah.
those have reached an unparalleled levels. It's we're close to 5%, and
Yeah.
that's something that is very very concerning.
If
If
you're Fed.
inflation figures continue to be at these levels
Yeah.
at which they currently are,
Yeah.
this is going to have a very detrimental effect on sentiment.
Indeed, and we're seeing lots of inflationary signs coming in. Oil prices being above 70%, natural gas spiking, electricity prices in Europe going through the roof, and container shipping rates being sky high. So there's a lot of input costs that manufacturers are facing at the moment, and some of these raised input costs are going to be passed on to the consumer in the coming months, which should keep the level of inflation elevated for a while yet. And it may be that inflation is going to be to remain high for longer than was previously the case. So in other words, inflation is being embedded now, as Victor is mentioning, with the inflation expectations. This is not something that the Fed wanted to see. But now, you know, when inflation expectations are rising, people are going to demand higher wages because they are expecting prices to rise. So they have to ask for higher wages. That in turn will create more inflation, which could become a vicious circle or cycle. So it's something to keep a very close eye on, and I'm sure the Fed is going to notice this as well, which may mean we may see a marked change in the Fed's tone in the coming meetings if inflation remains the way it is and expectations also remain elevated. Other than inflation, Victor, anything else in this week that you're looking at very closely?
Well, I'm continuously looking at China and the development, recent developments in its corporate bond markets.
Yeah.
High yield debt in China is currently yielding 14%.
Oh, wow. Okay.
This either means that we're about to see a lot of defaults, or it's the buying opportunity of a lifetime, or junk debt in China. I'm not in the camp that thinks that this is the buying opportunity of a lifetime.
Yeah.
I'd rather think that we're gonna see some defaults. And if you look at if you look at the Chinese stock market, it's been totally
going the opposite direction, isn't it?
Yeah. It's totally unhinged from what the rest of financial markets are doing. China, Hong Kong, if you want to display that as well, do you have it?
Yes.
Yeah. This market is also on a downward trajectory. We have seen some worrying crackdowns from the government, and private enterprises are under attack in China. So this transition and the lack of new, like over the past 5 years, 5 to 10 years, everybody was expecting how China is going to remove capital controls and liberalize its basically financial system, which isn't happening. And there's a lot of concerns that Chinese growth might be coming to a standstill phase. So that's obviously weighing on parties that are closely, like if you remember, the Aussie and the Kiwi dollars were flying a couple of
Yeah.
years ago. I mean, a couple of months ago, and now we're like we keep getting hammered lower in the Aussie. Like the moment it breaks through some levels, and you think, oh, now it's going to reverse,
and
it's going back down.
It's kind of mirroring the price action in the Chinese equity markets, isn't it? I mean, if we compare it with the China index, China 50. Let me just hide a few things because yeah,
you could say that.
Yeah. What have I done? Okay, so this is the Chinese equity markets, and the one below is in the candles. It's the Aussie dollar. You can see that both of them are following each other very closely. I'm just trying to figure out how to put the one of them on the left hand side of the scale so that you can zoom in a little bit, but you can see from this anyway how the two markets have been going in the same direction. So if you trade the Aussie or the Kiwi, because Australia is China is their largest trading partners, it makes sense to follow those markets closely. If you're a FX trader, just keep an eye on the indices, because for as long as China is struggling, the Aussie dollar is going to, find it difficult to stage a meaningful rally, especially the Aussie, because they have their own problems down under as well, with the lockdowns still in place for, I think, half of the country still is in lockdown. But
yeah, some people are joking that Australia is the next authoritarian regime. Now that it's been a while since you can't really leave the country or enter to the country, so
yeah. And New Zealand
that you've put together or allocating.
New Zealand dollar is looking a little bit stronger, in the sense that it's trying to break the trend line, still holding below. I think if it goes below this blue line here at around 70, 80-ish, that would be bearish, I think.
It formed a base around 70, 75.
Yeah.
And we've tried a couple of times to break through this trend line, downward sloping trend line, from March through June. From May. And yeah, something's off.
Yeah.
New Zealand is expected to lift its rates. And that's if that's not helping the Kiwi to break through new highs, I don't know what will.
So it's best then to play the Aussie again, the New Zealand dollar strength
Kiwi,
against the Aussie.
Yeah.
And there's a nice trend for me.
Position has been very profitable over recent weeks. We even mentioned it a couple of weeks ago, where you circled that recent pullback as an opportunity to buy the Kiwi against the Aussie.
Or to sell the Aussie New Zealand dollar pair,
So yeah, that's something that has worked very well so far.
Where do we go from here, Victor? Do you expect it to go all the way down to the lows that were hit in March
during the COVID panic?
Yeah.
It's possible. I would say that the long-term average, like if you zoom out on a weekly chart, perhaps, the long-term average of this pair, it's pretty like consistent around 106, 107.
Yeah.
I don't expect like a lot of further upside, just because obviously these two economies are very closely interlinked. And Once an imbalance of some point is formed, which in this case is obviously the outperformance of the QE,
Yeah.
Usually there is a reversal to the mean. So
Yeah.
that's what I expect to happen this time again. However, we're going to have to give it some time, and obviously the only buying level that you see, and it's a multi level, not marketing, multi level bottom. If you look at the weekly chart, it's down there, like it's firmly in the 99. One that parity
Level.
basically
Yeah.
is where you're looking to start accumulating the Aussie and
Yeah.
selling the Kiwi. So we're 300 pips away from that currently.
Yeah.
I don't think that this trend is stopping, and probably like it could pause for a bit once the Reserve Bank of New Zealand hikes interest rates, as that's already pretty much priced into the market. So maybe that's a good opportunity.
Maybe. As you were talking about that, I drew a couple of things on the chart, which it's something that I don't normally look at, but I keep it there just in case. You can see that there's a AB equals CD price movement completing around 103.50 to 102.80ish, this kind of area. So where it is today, it's where it should bounce if this is still if the rally of the March 2020 low was anything to go by, if that was a significant turnaround for this pair. So if it fails to hold around these areas, then in all likeliness, it will probably continue to head lower towards that March 2022 low, March 2020 low, at just below parity. So keep an eye on the shaded gray area that I've just drawn on the chart. And in addition, I'm sure there's a couple of Fibonacci things, retracements and extensions converging there as well. If you draw your fibs from this low to this high, you have the 78.6 to 61.8 there. And also if you draw your fib extensions from this to low to this high, you have the 127.2 extension converging between the retracement levels from the previous swing. So let me just get rid of the retracements. You can see that around this shaded area is where those Fibonacci levels converge with the prior breakout area. So we may see a technical bounce from there, which could provide an opportunity for people who are already short to take profits. But whether or not this will be a turning point for the Aussie Kiwi remains to be seen. What the bulls need to see is for price to form a higher high. So at the moment, the most recent high is this one I've circled. So if price goes above that high, then that would be a turning point for the market. So even if you see a rebound from here, just treat it as a oversold bounce in a downward trend rather than a reversal until the charts tell you otherwise. If you don't see a rebound and price kind of consolidates here for a while and then starts to break lower again, then that is your cue for the next swing lower towards the previous low at just below parity. Okay, so let's move on and look at some of the majors then. We talked about the Aussie and the Kiwi. The Euro dollar is still the chart that is stuck in a very narrow range. I mean, if you look at the weekly, it hasn't gone anywhere fast for the last several months. In fact, for the last year, it has been stuck between 116 to 123. that's a very narrow range for the euro, and it's a bit surprising to see some strength for the euro because of the dovish ECB stance. However, the eurozone has been recovering nicely in recent times. People have been vaccinated, the economy is rebounding, and things are starting to look positive in the eurozone. And this is why we haven't seen a more significant sell-off for the euro, given the Fed becoming so hawkish. So previously, I was expecting the euro dollar to bounce from this potential support area that I have highlighted in gray. It's struggling to do that.
In a way, it did.
It did a little bit.
Only briefly. Yeah.
Yeah. So we drew this line, I think, in the previous webinar last week, and it bounced from that level that we highlighted at 118-ish. It went to a high of what's the high of this candle? Hold on. So it went to 118.51. So it gives you about 50 pips to work with before resuming lower. What it does next from here will be determined, at least in part, by today's inflation data from the US. So far, it looks like it has trapped the bulls, because yesterday we had a doji-like candle, which looks kind of bullish rather. What should have happened was price to go above it and stay above. But as you can see, the euro has turned lower, possibly suggesting that it has trapped the buyers who went long above the high of that candle. So they will need a very weak US jobs report in order for the euro dollar to turn around and go higher.
You mean CPI report?
Yes, sorry, CPI report. So that's the scenario there. If the jobs report comes, CPI report, I keep saying jobs, it comes in lower, then I would expect as a minimum for price to take out the liquidity resting below the doji candle, which is where people who bought on the back of this are likely to have placed their stop loss orders. So in other words, I'm expecting in the event that the CPI data comes in stronger, I'm expecting the euro dollar to at least drop to 117, to drop below 117.70, possibly 117.50 before it decides on its next move. But trading effects has been really difficult, to be honest, in recent times. It's when the markets are just stuck in ranges, you'll get to see lots of false breaks and false moves. It's not an ideal market to trade right now. You're better off looking at things that are trending, like the Aussie Kiwi that we shared with you before, yeah, concentrating on those kind of prices or markets make more sense from a technical and trading points of view. Anything else you want to cover, Victor? I mean, the pound is looking a little bit more bullish, isn't it?
Yeah, we look at the British pound. It's still going nowhere.
Yeah.
To start with, but we've been seeing this range between 138 and 139-ish, roughly. What we need to see is a break above 139. I think, in order for the bull trend to resume. On the downside, I feel like at this point in time, if we close below 138 on a daily basis, we could see another test to the downside towards 136.
Yeah.
It's struggling to make headways here.
Yeah. So in terms of today, the short-term support level would be yesterday's high, I think, around 138.50, if you're a short-term trader, because that's the breakout level, isn't it? Insofar as today is concerned, maybe a dip back down to that level and resumption higher is the way I would play it. But then if it starts to close, if it closes back below 138.50, that would be a worrying sign, I think, for the bulls. But like the Aussie and Kiwi, the pound is doing relatively better than the euro. And previously, I was expecting this area, a break below this area to signal that the trend has turned bearish, but we've already got that, because since I drew this, prices moved higher and created a higher high here before taking out the low that was created prior to price making a higher high. So below this level, the price is bearish. So if you're struggling for ideas, this could be another market you may consider looking for short trades, selling the resistance, selling as close to resistance as possible, and expecting prices to head lower. From here, I think as a minimum, I think 84 is going to be the next level of support, potential support. But my longer term target is at around 83, which ties in with the previous swing lows. The UK economy has been performing slightly better than the Eurozone. And obviously the UK being out of the Euro, out of the European Union, the government is able to do a lot more now. Its hands are not tied to the rest of Europe, meaning it's able to easily increase fiscal support if needed, which is not something I'm expecting, obviously, because the government has announced a rise in taxes and national insurance. But anyway, the virus situation is really still, cases are rising, but the death rates have been very slow to rise. So it doesn't look like that the UK is heading for another lockdown. Although I say that with a pinch of salt, you never know. But vaccinations have been ongoing at a very good rate. And
at least until we get a new dangerous mutation, probably that won't.
Yeah, let's hope we don't.
We're all hoping for that.
Yeah, indeed. Let's have a very quick look at the bond markets, okay? Because bond markets tell you lots about what you need to know. The 10-year US yields have been consolidating in a very tight range, but we are starting to see a breakout from this bullish trend line, which is possibly a bad sign for gold if we see some traction in this on the long side. It could mean positive development for the dollar, so long as other yields don't break out similarly, like the German 10-year or the UK 10-year. Let's have a look at those. This is the German. Well, the German 10-year yield has been climbing higher, like the US 10-year.
It's been flying high towards minus 0.3%. Beware.
Yeah, so it's not exactly flying because still underwater. This is zero level here. So if you park your money with the ECB, you still have to pay them the privilege of doing so. UK yields have been going up more noticeably, as you can see here. And for that reason, I think you're better off trading the euro pound on the short side until the markets tell you otherwise. Because on a relative basis, yields in the UK are rising at a faster pace than the Eurozone. And maybe even the rate of change has been faster than US yields in the last few days, which is why the pound dollar has been strengthening. Let's look at gold, because we mentioned that I was looking at this particular level previously, this black line here. Just get rid of this. This level was the last low gold had made prior to its most recent breakout attempt. Well, that has failed. It stayed above this area of congestion for one day, and then on the very next day, it took out that level. Since then, it has been consolidating below that level of breakout, and for as long as it now holds below this, as it is right now, the path of least resistance is to the downside. So if we get a strong inflation report out from the US today, we may well see some further weakness in gold prices to take us down to at least the 61.8 maybe of this swing. At the 61.8 comes in at 1740, which ties in with this particular level, the point of origin of the previous breakdown. Will it come all the way down to this area? Who knows? But if it does get there, you may want to take some profit if you're short, because it could very well bounce from there. Gold has a tendency to respect the 61.8 Fibonacci retrace, I've noticed. But we'll get there. We'll cross that bridge if it gets there. Right now, the key area that needs to hold is around 1780-ish, 1785. This area here. It's struggling.
Yeah,
it really is struggling.
We've seen another bit of consolidation over the past 4 trading days, and today it's the 5th. So yeah, let's see how that goes. Obviously, the CPI data is going to have an impact on this pair. On this asset as well.
Yeah.
The higher the CPI number, the lower gold prices might end up.
Yeah. One thing though, a high CPI print is expected already. 8.3 is expected figure, I think, on the year-over-year inflation headline.
Sorry, 8.3.
I think it's 8. Did I say 8.3? 5.3.
5.3. Yeah.
Yeah. I don't know if you guys heard me saying this at the start of the webinar, but I've only slept like a maximum of 2 hours today, last night, because of my ill wife. So I keep making, I keep calling a CPI, what did I call it? Non-farm payrolls report or something earlier, and now I'm talking about inflation at 8.3%, but no, I meant 5.
That just might be a prophecy.
Maybe. Let's see. Silver is likewise very struggling to do what it should be doing. When it broke this bearish trend line, I was expecting this not this gray region, this level of support right here at 24.26 to hold on the retest, but it didn't. And as soon as it went below, it has remained below that pivotal level since. So this bullish scenario that I had expected did not play out. We can get rid of that now. We can move this trend line a little bit higher now to incorporate these new highs. And for silver to really start showing us bullish characteristics, it will need to take out this bearish trend line as a minimum. Ideally, it would also need to create a higher high above 24.80-ish. But yeah, the bearish trend is the first level of resistance that needs to be taken out.
Well, the bear trend is intact, we could say, and the 2250 level is in sight. Again, like so contingent on the CPI figure today.
Yeah,
I think that once we take that out, we could see even a test of 20.
Wow. So yeah, I mean, there's not much noticeable support levels in this.
Well, there is 2150 or thereabout,
Yeah,
previous
21,
low from
25,
September.
or this level.
Yeah,
Okay.
well, 2170 you can call it. But I think that it's a minor level, and it would be easy to take that out and just aim for the psychological level at $20.
Yeah,
See what happens.
if it gets there.
Yeah, sure.
Yeah. So there you have it. If you're bullish, wait for the break of the trend line. If you're bearish, some of the levels to watch to possibly look to take some profits around would be 2250, as Victor mentioned, 2165, and then the big level is at 20. If it gets there, I'm doubtful it will get there, but if it does, then that would be a massive level to potentially look for long trades. Let's have a look at a few other markets. Crude oil is looking bullish still, because price has been making it's made a really nice recovery from this big drop that we saw in early August or in the middle of August. Since then, it has been consolidating here ahead of this bearish trend line, which it broke a couple of days ago. So now I can move this bias bearish level a little bit higher to just below this low that was made prior to price breaking out. So if oil were to come back down and take out this low, then at that point it would be it would have trapped lots of bullish speculators, and there'll be lots of stops resting below this level. We could see a sharp move lower. So the line in the sand is at 67.60 for WTI. But for now, the path of least resistance is to the upside because of the break of the bearish trend. So we saw a record fall in US oil production because of the hurricane there. And apart from that, I'm struggling to think what else could hold oil prices at these levels. Do you have any strong views on oil, Victor?
Well, I do have. I do hold the view that these levels are very harmful for economic growth in emerging markets, and
indeed,
they're causing a really difficult situation politically. This is probably something that the UAE has alluded to at recent OPEC meetings, that the current levels of oil prices are risky in the long run, because if we have higher oil prices for a protracted period of time, that obviously destroys economic growth prospects for those countries that are that couldn't afford the levels of fiscal stimulus that the Western economies have executed. So
especially countries like India. India is an oil import nation, and
India, Turkey.
You could add a few other countries in that region. But yeah, India, China, of course, we can't forget China.
Southeast Asia, obviously.
China actually tried to do something about the strength of oil by releasing some of their oil reserves. That didn't work out very well, because
it was very short-lived.
This
we had
black candle was
towards 67.60, and that's pretty much what the Chinese move did.
It was only a little knock to the rally before it resumed higher. Let's see, China might decide to release more reserves, and the OPEC obviously could decide to ease its restrictions faster. meaning more supply from OPEC could come into the market.
Yeah. Well, what the OPEC itself has been telling us is that the deficit for oil is going to persist throughout until the end of this year, and next year they expect for supply to be higher than demand. So
Yeah,
let's see what happens. Yeah, if that is the case, indeed, I don't see oil continuing to trade at these levels for too long.
yeah,
However, you know, it's very difficult to time a market top.
yeah.
And if we look at the longer term chart,
Sorry, I just
yeah.
US. Yeah,
If
do you want to
we
look at
look at
WTI or Brent long term?
Yeah, either. If we look at these weekly levels, we had
This is the
yeah,
monthly, weekly chart of Brent.
yeah. There is this monthly chart that we have tested the downward sloping trend line around 77.50. We did correct after that.
Yeah.
So now what I would be looking for is a false break above 77.50 to take another go at
Yeah.
the downside.
And then if that fails, then that could be the signal to go short.
Yeah.
Yeah. Either that or if we see some interim reversal or break below this as well. Yeah, that could be another. What about you know, the scenario that we don't see happening? What if oil prices continue to accelerate to the upside? Could it possibly get to 85? Brent, could we see a massive breakout? You know, it's possible.
Yeah, of course. Yeah.
Yeah. Supply shock. You know, I don't think it's gonna be because of some demand story. I think if that happens because of some supply shock, we could see, for example,
tensions in the Middle East. Or
yeah, tension in the Middle East or further hurricanes in the US hitting supplies or whatnot. It's entirely possible, but it's not the base case scenario for us.
Sure.
Let's conclude with looking at a few indices then, shall we? And if there's demand for it, we can look at a few cryptos. So please ask us questions if you haven't already. But we shared the chart of the S&P with you guys earlier, the one with the trend line, this one. If this breaks down, it could lead to some volatility, at least some technical selling below it to take us down to a few important levels like this level right here at 44.20-ish, 44.19. Below that is the price swing low at 43.52. That level will need to hold, obviously, because that's the previous swing low. Below that, things would start to look bearish. Nasdaq is the one I'm looking at very closely because bond yields are on the rise. When yields rise, it's not good news for technology companies, right? So, you know, Nasdaq.
Yeah, we also had a very rocky week for Apple last week. One of the big drivers for this rally actually encountered some resistance in the face of one of the developers of a very popular game called Fortnite, Epic Games.
Oh yeah.
The court ruled that Apple is basically abusing its dominating position on the App Store and needs to provide alternatives for companies to be able to collect payments for their products. So this has actually caused this last significant dip from 57 or thereabout to 149, back below 150, and it's something to look at. If we do have one of the big tech monopolies getting hit by a court decision, it could be only a matter of time until we see some others do.
Indeed. Interesting you're talking about Apple, because today I think they are announcing new products, new iPhones, and
yes, they are. I don't see that really as something that might change the company's valuation much, because it's widely expected. There have been a lot of leaks recently that have.
So what are we looking at? An iPhone which is a little bit faster than the previous one, with another camera or something?
Don't expect anything radical, except for some camera improvements, and it's an iterative upgrade, you could say.
Yeah, it's becoming increasingly difficult, to be fair, for these kind of companies to come up with new innovations, because let's face it, the iPhone is an amazing product. There's so much you can do to improve it from what is already a very, very beautifully designed and
useful product.
Very useful. Yeah. So it's I mean, we can be critical of these companies to come up with new innovations, but there's so much they can fit in that little device, and
the
really
next
perform
category of products that Apple is expected to delve into is AR and VR, and we are yet to see what do they actually have in store.
Let's have a look at a few European indices, and our favorite one, the DAX, is broken its trend line already. So if the DAX is something to go by, then we may see that S&P 500 also break its own trend line that has been in place since 2022. 2020.
Yeah. What about the FTSE? That has been underperforming recently. Do you think that's related to the tax decision? The increase in corporate tax rates.
Possibly. Well, there's so many reasons for the FTSE's underperformance. The tax reason, more to the point, I think it's the strength of the pound. The FTSE 100 companies, they earn most of their earnings abroad. So a strong pound is not good for them, because when they convert those earnings back to the British pound, it makes their earnings appear less than they would in foreign currencies. So I think that's one of the reasons. China is another reason, obviously. There's some Chinese linked to stocks in the FTSE, like commodity stocks. And I think Standard Chartered is still in the FTSE, if I'm not mistaken, which is a China-focused bank, HSBC.
And it's basically there is not that many tech companies.
There was one tech company, I can't remember which one it was, but they removed that one. So yeah, the FTSE really needs to up their game and come up with some newer stocks, growth stocks. It's got lots of value stocks, but not many growth stocks like in the technology sector.
Yeah, well, even UK tech companies are using the US stock markets to list.
Talking about breakdowns of trend lines, we forgot about the Dow. The Dow has broken its trend line, as you can see here. So maybe this is the start of a bear trend for the stock markets, dare I say. We have already seen the Chinese equity markets come down
quite sharply. The B word. You heard the B word.
It is, I don't have a particularly stronger view, a strong view in terms of the market direction. But if this is anything to go by, like we may see some weakness come into the market because the investors are running out of reasons to continue buying stocks at these elevated levels. So a correction is overdue, is long overdue. Could it start soon? Could it start this week? Could it start with a above forecast inflation print today? As among a few questions that investors are asking themselves right now. So there is lots of risks coming into the market.
Indeed. So watch out for this inflation figure today.
Yeah,
it would be the most important one in a while.
Indeed. With that, I think we have run out of time. I can't see any questions. So let me thank you for joining us today. I hope you've all learned something new from us. Please make sure to join us next time at the same time. And you can do that by going to our website and then go to market analysis, hover to live on live webinars section. And here you will see a list of upcoming webinars. We did this one today. And you can join Victor and myself for the next one, which is happening on the 16th, which I believe is on Thursday. Yeah. You can register for that by clicking on the register button. And Victor will be leading that webinar. He has some very interesting things to discuss in this webinar. So please make sure to join him. And our next live market analysis webinar returns next week, same time at 11:30 London time on the 21st of September. So you can register for that one as well. I hope to see you guys there. In the meantime, be safe out there and try to keep a very close eye on the stock markets, which are showing some signs of weakness. Take care. I'll see you next time.
Take care. Bye-bye.